This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is the show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes, type in Old Dog, spelled D-A-W-G, find our podcast, and subscribe. Well, we have a very interesting show planned for you today. I have, we're kind of departing from our normal focus on those that are 50 plus, and there's a lot of people that listen to this show that are working. Some of them just starting out in their careers, and all of them are concerned about just making good investments with the funds that they're generating. And this guest that we have is a gentleman who has a very successful practice. He's a doctor, an accomplished physician, entrepreneur, asset manager, and podcaster. His name is Buck Joffrey. Since finishing his medical training in 2008, he has had tremendous success through his startup businesses and investments, going from being broke to having an 8-figure net worth. In order to help his high-paid professional colleagues, he started a financial education website called wealthformula.com and hosts the popular Wealth Formula podcast. Buck knows the old mantra of investing in a diversified portfolio and mutual funds is outdated and dangerous for high-paid professionals given the volatility and instability of the current global economy. Therefore, he advocates entrepreneurship and/or investing in hard assets that provide a cash flow as a more reliable way of approaching personal finance. Through a strong foundation of financial education and emphasis on cash flow investing, Buck teaches professionals how to take charge of their money and prosper. Well, Buck, we are very, very tuned into cash flow. In fact, that's sort of our mantra here. Cash flow is king. And I think it's just really interesting that your background as a physician, a professional who really doesn't have to do anything other than what he does and enjoys doing, but you have really looked at taking a much broader perspective, and we'd just love to hear about your approach to investing and how it might pertain to our audience here.
Yeah, so thanks for having me. My approach is, I think it's influenced by, when I finished training, which was in 2008, 2009, right amidst the Great Recession. And, at that point, looking around, there was plenty of very successful people that I knew, including some of the senior doctors who suddenly, were losing significant portions of their portfolio, and any plans of, retirement or whatever they had sort of went out the window. I think that was an eye opener, and at that same time, I happened to come upon a Robert Kiyosaki book called The Cash Flow Quadrant, right after finishing training, and it sort of just changed the way I think. I was a classic academic guy, academic surgeon. Went to some of the high-powered academic facilities for training, and published a lot of papers, and was involved with scientific research, and a lot of that was sort of burned out in me by the time I finished training. So I was looking for something new. So this is that's the perspective I had. So what I did know is that my father, who's in his late 70s now, was an immigrant and came to this country in the late 60s on an engineering scholarship. Practiced as an engineer for a couple of years. And then started shunting his, some of his funds directly into real estate. Has been a real estate investor for, over 40, almost 50 years, and made a lot of money. I never had any problems when I was growing up. I didn't grow up poor. I wish I had that story to tell everybody, but I don't. I grew up well-to-do. My dad paid for college and medical school, and so I was in a good position. The only thing was that part of the downside of that is never really understanding where money came from. And so when I started making money, I didn't really know what to do with it. And I started going back on what my dad did. The only problem is I didn't want to be a landlord. I had no desire to be a landlord. My dad clearly was one. The phone used to ring off the hook, all day long, every day. He owned, hundreds and hundreds, thousands of doors, and he was micromanaging everything. I didn't want to do that. So for me, a good approach was, okay, let's approach this more as a business. And I had some significant success in, as you'd mentioned earlier, in starting businesses. And so I used the same approach to real estate and my investments as I do to the startup businesses, which is, let's look at it as managing assets. Let's not look at it as being a landlord. And it's worked out very well for me.
And I think that does apply a lot to people that are retired too. That they don't want to have to deal with tenants' toilets and trash, so to speak, and they really want just a steady stream of cash flow, and that appeal is obviously your focus as well. And I'm kind of curious too, as I've read your material and so forth, that you have zeroed in a lot on your funds. I'm sure there are a lot of opportunities out there for other types of investments. But is it because your father was involved in real estate investing and you saw how it worked that it attracted you to that first?
Yeah, I think the first step in real estate, frankly, I think we're looking at it as a potential investment vehicle or as a career is overcoming the fear of real estate. I think a lot of people think that it is, quote, risky. And I never saw it as risky because my dad, did real estate his whole life, and he wasn't a flipper. He just bought real estate and held on to it. And he made a lot of money doing it. And when economies went south, like in 2008, instead of suffering, he went on a big buying frenzy and made a lot of money doing it. And so I wasn't afraid of it. That's probably the number one thing. But in reality, I look at it. I'm a surgeon by training, and I don't practice very much anymore. I'm primarily focused on my business activities and my investing, but the surgeons look at things in a very different way than, say, our counterparts who are medicine doctors. And we look at things, some things there, we need to cut it out. We need to fix the piping, whatever. We look at things in very different, in very discrete and very solid ways. It's the way I look at the world. And so looking at real assets, meaning actually owning a building, or owning, and some people own single family homes, or owning farmland or owning precious metals, to me is a lot more comfortable than owning a piece of paper. And the piece of paper that is is supposed to reflect some value of some equity in some company, but seems to go up and down without any rhyme or reason. And so So that perspective for me is actually, counterintuitive. I like simplicity and the elegance of owning real assets because I understand them.
And maybe you could share just a little bit with us about your first sort of major property purchase or investment property purchase.
Yeah. So my first one, I looked at it. It was probably back, say 2011 and 2010, 2011, and it was like a 14-unit apartment building, and actually it went very badly. So,
oh wow! Okay, this could also be your biggest mistake. You could share with us too.
Yeah, it is. It is the biggest mistake, and honestly, it's you wonder why in the world I would still be in real estate after this. But I had a building that I was looking at, and this was coming off the heels of, again reading Kiyosaki's work, and then looking at what my dad was doing. I didn't ask my dad for a lot of advice on this, frankly, because, like any son, I didn't really think he really understood what I was trying to do. And so I was looking at this property, and the numbers look great, and I can do a spreadsheet with the best of them. And
what kind of property was it? Just
it was a 14-unit, 15-unit apartment building in southern suburbs of Chicago. Mm-hmm. And it was, it was a Class D property, and that's one of the reasons why the numbers look so good. And the problem was that there was, in retrospect, there was some, the previous landlord, and when I say landlord, it was essentially a guy who owned a number of buildings in the surrounding area. And it was pretty clear what had happened is that he'd stuffed the rent roll. And, in retrospect, I can look back at that and say, well, there was a million signs and I, could have figured it out. But, it's a school of hard knocks, right? You learn from your mistakes. And I probably ended up losing $300,000-$400,000 on that building before it was done. But I learned a lot and never made another mistake like that again. And, so for me, that was one of the reasons, first of all, a few things that I learned from that, and everything that you do, you learn from, right? And for me, it was one, I'm not doing Class D buildings ever again. Two, I'm not going to ever buy a property that is not professionally managed by, a third party manager that is not affiliated with the owner of the building. So that's two, because there's too much opportunity there to cook the books. Three is bigger is better. And that might be a concept that I don't know if it might be new to some people, but I truly believe, because in my other business activities, as the businesses have grown and revenues have grown to from where I started at $1 million, $2 million, now up to close to $20 million, these types of businesses become increasingly stable and less dependent on a person. They become less dependent on a single unit. They become less dependent on single variables, and for that reason, they end up becoming a lot more stable. And so my own approach now is to stay away from anything less than, say, 80 to 100 units.
Okay. And well, how many units or doors do you currently have?
Well, I probably have, I have ownership probably about, it's probably, they go up and down. We sold a bunch of stuff, so probably about 500-600 doors. Okay,
so you will be participating in other projects as well, where you may not be necessarily the principal, or do you have a controlling interest in all those properties?
I have a controlling interest in most of them, but I will participate in other, passive investments as well. I mean, it's not just about being in control. It's about getting a good return. But, I think that the challenge with being a passive sometimes is, for a guy like me, I have to have control. I have to kind of know what's going on. I'm sort of a ground up guy. I built my own businesses from the ground up, and therefore it's easier for me to be in the driver's seat.
Oh, sure. No, that's completely understandable. The what is sort of the typical scenario in terms of the property you're looking for? Are you going to hold it for a long time, or because you have investors, or not? Do you hold it for a 3 to 5 year period? And what class and so forth? You mentioned 80 plus units. What other factors do you look at there?
So I would say first B and C class. Typically I'm going to stay away from the A class, because when the economy goes south, the first thing that goes south is the A class, right? People who are making a lot of money need to move down into the B classes. The B classes move down into the C classes, and I stay away from the D class for the reasons I mentioned earlier. Right. But that's one of them. The other thing is, in terms of what else, in terms of what I'm really interested in is value add, but I don't want to be heroic. And what I mean by that is, listen, there are syndicators out there, I think, who are doing a great job, who, are finding properties that are on sort of their last breath and are about to die, and they resurrect them, and, they end up making a lot of money. But for me, I'm not that interested in that right now. I'm interested in cash flow, as we talked about before. So if we can pick something up and do a few things, whether that's, put in better management, whether that's, just updating a few things and so on and so forth, and increasing cash flow, that's where the type of property that I'm interested in. Now, specifically, if you're talking about, what a business plan that I would put out might look like, it would typically be a 5-year projection. Okay. Now, the 5-year projections, I think, are really important, particularly if your listeners are listening are looking at multifamily deals. And there's lots of them out there right now, and there's mine, and I'm not by far even close to the only one doing this, but there are plenty of syndicators out there. But the things to be wary of, I think, when you look at a 5-year projection are, what is a projected, what's a projected increase in rent over the next 5 years? I mean, you might find that there's a reason why it's over 2% per year, which is reflecting inflation, but you really want to find out why. Because sometimes I see people sending me stuff and then showing 5-6% increases in rent, and I don't really understand why. Well, that's a concern. You also want to see what the reversion cap rate is, right? You want to see what somebody, if they're planning on selling in 5 years, what do they think that property, what the inherent property value in that area is, and why? I don't know if you guys talk about that term very much, cap rate.
Yeah, actually we do. In fact, what is your target minimum cap rate? And just also a kind of second half of that here, do you buy only in your area, or do you buy out of state?
No, I'm most of the stuff I own I own stuff in Illinois where I am. I own stuff in Texas, surrounding Dallas area. And I also, but I'm looking in other markets. I mean, right now, I have an analyst who's looking at a lot of deals in Phoenix too. We put a letter of intent out on a couple of deals. They didn't work out, and again, part of it is because people are paying too much money for them.
Right.
So it's opportunistic. There really isn't a local thing here, and I'm looking at it as very much where the opportunity is. I mean, there's markets to get cash flow, but then we also have to be very wary of where the market's at right now and where it potentially could be in the next few years.
Are you again just kind of zeroing in on those key ratios or factors? Do you look at for a minimum cap rate, cash on cash return, so much per door? I mean, how are you assessing your deals that you would want to target?
Well, I think, what it really comes in, it's not really, for me, it's not really a number per door, because obviously if you're in an area that's commanding a lot more rent, then, you might pay a little bit more. But for me, I think the biggest indicator for me is cap rate. But the challenge with when you're looking at properties, especially, in 2016, in December of 2016, as we talk, is that a lot of those cap rates, as you know, and I'm sure your listeners, if you're looking at multifamily, know those cap rates are compressed quite a bit compared to where they were 2 or 3 years ago.
Right, right.
And so does that mean we don't buy? No, it doesn't. It means we have to be a lot more selective. And you might not find deals that, are a cap rate of 8 on day one. But that's where the value add comes in. I think that if you can buy something, say you buy something at 6.5, but you have a good business plan to bring rents up and improve the property. And my goal would be to be able to provide a realistic, projection, 5-year projection of a, close to 20% IRR. So I'm trying to return 100% in 5 years. Now, the projections that I'm going to have, I think, are going to be pretty conservative. So if we end up, 85 to 85% instead of 100%, it's because I don't want to pretend that it's 100%.
Right.
We're going to use the cap rates that I'm going to use in the reversion cap rates. So when you're going back and you're saying how much you're going to sell this for in 5 years, well, that's another thing that you have to look very closely at. We talked about rent escalations, but sometimes you see these properties and they're projecting 120% return, and then you look at what the cap rate at sell is, and it's down at like 4 or 5, and it's crazy, right? I mean, I think you have to look at today. It's hard to predict what's going to happen, but at best, your cap rate is going to be what it is today on the way out. Right. I mean, that's the way you have to look at it and hope it's not worse. That said, you want to have a property that if you don't feel like it's a good time to sell, that you're willing to keep for another, 5-10 years. And who doesn't want double-digit return? So it's not the worst thing in the world. It just happens to be, if you've got a property worth hanging on to, then hang on to it unless there's an opportunity to sell. I think that's really important because I think, it's funny when you talk about, so I was talking to somebody about one of my businesses the other day and about potentially selling it at some point. And he said, well, is it a business that you don't want to sell? I said, well, I don't know. I mean, of course I'd want to sell. He said, well, the problem is it's a business that you want to sell. So if you want to sell it, if you really want to sell it, then somebody else may not want to buy it. So you want to have a property that performs really, really well, and that you're not, that you're okay holding on to, and that's when somebody's going to pay a lot for it. So.
Right. And you mentioned other businesses. What other businesses are you involved in besides real estate?
Yeah, most of I have multiple businesses in the healthcare area. So I own a number of clinics of different varieties, and whether they be in cosmetics, cosmetic surgery, and sinus and allergy, behavioral therapy, and and obviously, I have got what I would consider my syndication business, essentially, which is trying to find the properties and then manage the assets. So,
and your syndicate, do you have now? Are you getting different investors for each property, or do you have sort of a bank or a fund, of investors?
So the investors that I have are mostly frankly from my podcast. My podcast tends to focus on high-paid professionals, doctors, lawyers, MBAs, whatever, who have money, who are not really interested in getting ripped off by Wall Street. So through my website, they can sign up for something called Investor Club, and it's it's limited to accredited investors, but it's where I present deal flow, and I should point out it's not just deal flow, and it's not just my stuff. So what I like to do with that group is, first we all get to know each other, but it's also an opportunity for me to present things that I'm doing. For example, it's December, and a lot of people who are making money don't realize there's lots of ways you could potentially save money on taxes, right? Mm-hmm. And so I may have a webinar with somebody who gives you some tax, gives tax tips and opportunities that you might not typically know of. Whether that's various investments in oil and gas, conservation easements, any number of things that the typical public is not going to be aware of. The other thing is I believe in abundance. So, when somebody has an opportunity that I think is a great opportunity and I have nothing to gain from it whatsoever, I'm happy to put them in front of my investors and let them know about what kinds of things are going on. So,
great. Where are you finding your real estate deals for the most part?
That's a good question, because I think part of the challenge with being successful as a syndicator right now has to be, is the ability to find the deals, and that's a full-time job. It really is. You got to underwrite deals all the time. So what I did is, I have my own analyst who all he does every day is, contact brokers, tried to contact, sometimes in some case sellers, and tries to source deals. And that's kind of what he does. And, the problem is, we underwrite 30 deals and we might make an offer on 2 of them and neither one of them make it to the, we're not going to overpay,
right.
But it's a full-time job, I think, to find real deals. So.
And they're primarily off-market things that you're investing in?
No, I would say that, with these larger apartment buildings, it's a relationship game, because typically it's a selling broker who has a property, and you might get a pocket listing, you might get something, exposure to something before others. Just because of the relationship that you've formed, or maybe in my case, my analyst who's used to work for a REIT has formed in the past, we might have an opportunity to get exposed to something earlier. But I think it's, you see it sometimes, but most of the time it's the old-fashioned, there's a deal. It's not going to be on the MLS because big apartment buildings don't typically come on the MLS, but they're from brokers and broker relationships.
Are you getting any call for offers, those types of emails and so forth, or you try to avoid the bidding types of projects?
Well, I see those all the time. I think that for me, though, it's pick the market and then see what we can do in the market, and if it doesn't work, move on to the next market. I'm seeing some of those deals. And I don't think that I don't think that just because they're out there, being marketed, that they're not necessarily good deals. I'm willing to look at any deal that fits our criteria, like a stable market in B and C that might have some value add. If it fits that criteria, we'll underwrite it. More often than not, they're asking for 25% more than we would ever dream of paying for it. So then we just push it aside. But there was a deal. There's a deal I'm still waiting that in Fort Worth right now that the seller had a buyer and it fell through, and I came in and I've got a strong offer, and I'm just waiting to hear back from the guy. And if he wants to sell, I think it's this was a deal that was on the market, and I think it would be a great investment. So I don't think that there's I think it's a myth that the best deals go sort of unfound. So
right. What would you say is your biggest investment success so far?
Well, I think there's I've had a number of successes in my startups, but those are probably less relevant. But I think a couple of investments that I made in smaller apartment buildings, like 20 units or less, and this is before I was syndicating. So this was probably back in 2012. those were truly off market. So to your point earlier about off market deals, of course, if you can find something like this that's 100, 200 units, it'll be golden. But what happened was, fortunately, I got to know a lender pretty well, a broker, and he presented me a deal in a situation where there was a couple of 20-unit buildings in the Chicago area, in up-and-coming neighborhoods that a seller needed to get out of, not because there was anything wrong with the property, but because of a particular loan situation he was in. He needed liquidity. And so I was able to buy both those properties probably at a 15-20% discount. And the timing was such that the cap rates in those areas when I bought them, the market caps were probably around 8. And then I got a 20% discount on top of that. And
that's
both,
great. Wow.
Right. Well, now in those same areas, the cap rates are, recently looking at those market cap rates, they're just above 5. So literally on each one of those properties, in less than about 4 years, I made at least $1 million in equity in each one of those deals. So.
Oh, that's great. Now? A lot of our listeners, it's a broad spectrum, as I mentioned, but are really the folks that we're targeting this show toward are 50-plusers, people that maybe they're employed and very, a nice job, but they're concerned about retirement and having the funds that they need. Others may be in retirement already, but they have the resources, but they're kind of afraid to invest because their nest egg, they've either seen the folks that have suffered during the 2007-2008 crisis, and they're concerned about moving forward, especially in real estate. What kind of advice would you give to those individuals that are in that place, looking at real estate as a means to be able to augment their retirement years?
Yeah, so I think it's a very good question, Bill. The problem with what we're talking about here is essentially what you're trying to do if you're trying to retire and focus on these kinds of assets for your retirement. I think it's a very good idea. The challenge is where do you find deals, and where do you find people who you can trust? And that's a great question. It's a very good question, because the problem is it's a little bit of a feeding frenzy out there right now, as you know. And I think my advice would be first, try to invest with people who you get to know, who you like, who you trust. I mean, that's always my first and foremost rule. When I invest with somebody, it's usually either because somebody else has invested with them that I know, or I've invested with there's some credibility that I am aware of firsthand, so that's one thing. The other thing is that one thing that helps with that is trying to get involved and be part of a community. And that's where, for example, in my case, where I have my investor club at wealthformula.com, which is, I know a lot of people putting together deals who I know, like, and trust. And therefore, I can help provide that community to a certain extent. But obviously it's not just me. That's not the only way to create a community. My point is, if you are in a community where people invest like this, you're going to find others who've invested with various people in various programs and various assets that they've had success with. You don't need to go in there and be the guinea pig. I'm happy to let somebody else lead the way in a dark cave. So,
where do you see yourself going? I mean, you're still a young guy, and you have a lot of time ahead of you. Where do you see your business going in the next 10, 20 years?
I think for a guy like me, I'm actually retiring from clinical activity in July. So I'm done with that. So I own the businesses. I own the medical stuff, but I won't actually be doing any of it anymore. Right now I'm down to 2 days a week as it is. But so after that, I think it's just a matter of, for me, what's exciting is growing and creating, businesses. So I'm going to continue to try to grow my businesses, try to develop layers on those businesses. I mean, certainly with the podcast, it's only, in reality, I've only been doing it in earnest for about 6 or 7 months, but it's gotten a lot of traction and a lot of interest, and I'm having a lot of fun with it. So I think, just continuing to do that, having fun, because the beauty of that podcast is it's really opening doors for me as well, and I'm meeting interesting people, and I'm having there's great opportunities there. And then of course that also helps with the asset management, because I can present deals to investors that I feel good about, and obviously I do well because people invest with me and my investors do well. And then I want to take that to the next level. To grow that sort of back-end asset management company. I'm hoping after a few years I can get my brother to join me. My brother happens to be a chief investment officer of a major sovereign wealth fund in the Middle East, so he knows a thing or two about investing money. And so we're going to try to go big.
That's great. That's great.
And at the end of the day, it's really, for me, it's not just about money. I've made plenty of money, in the last 8 years. It's about having fun, and it's about creating new things, and just the excitement of it all.
Just out of curiosity, with your clinics, do you also own the real estate that those clinics are in?
In one of them, I do. Yeah.
I mean, that to me sounds like a great strategy too, if you were so inclined. My favorite response to a question is Ray Kroc. When he asked about McDonald's and said, what business are you in? If you're not, he had said he's not in food services, and he goes, I'm in real estate.
Yep.
He goes, I'm really in real estate. He owns some of the best real estate across the world, and I was just wondering if that was part of your strategy with your clinics.
It's not right now, and I don't know if it will be later. But that's I think, anyway, it's a complicated thing, but, the challenge, I think, right now is really about figuring out where the best yield is and where the best use of capital is. And I also, one of the downsides of having your business in your real estate is, of course, you've sort of tangled up the risk management there, right? So if one doesn't, if for some reason a business didn't do well, then guess what? You're not getting paid rent either, and so that's another issue.
And that's one that I look at myself as I'm investing in commercial property. Apartments, people are always going to need a place to live. I don't care how bad the economy is, they still need a roof over their head. Whereas, some commercial buildings, office buildings and so forth, businesses during a tough economy, close up, and, trying to fill those types of spaces is, I think, a little bit more challenging than residences. So,
I agree with that. In fact, if you look at, one of the things I always talk about is a Maslow's hierarchy approach to investing, right? So you've got, what do people need? And, and why don't I invest in A class? Because, A class is a luxury, working class, B and C is where people typically need to live. People working, people live there. Right. So there's that. And so if you look at other things in that, it doesn't have to be necessarily owning real estate, but even owning the debt on real estate, owning mortgages on real estate. There's so many things that you can do. But I think if you think about the things that people need, and I think that certainly provides a safety, a little bit of safety to your investment.
I agree. Well, gosh, this our time has just zipped by, Buck, and I'm kind of going, man, oh man, where did it go here? Because there's so much more I'd love to talk to you about, but we're kind of running to the end of our time here. I want to respect your time as well, and we have a little section at the end of our podcast here where we ask you about we call it the wrap it up section, and I just ask you a series of quick questions, and you give me your quickest responses you can, and that gives some good resources for people to be able to jot down as well. And for those listening, just keep in mind, everything that he mentions as we've talked here today is going to be in our show notes, which is on our website at olddogsreinetwork.com. In the blog section, you'll see all the show notes summarized, as well as links to any kind of references that he may have used as well. So we're going to go ahead, if you're ready, go into our wrap it up section. What is your favorite real estate book?
Probably the ABCs of Real Estate, Kenny McElroy.
Yeah, I love that. I love that too. Great. Mm-hmm. Favorite business book?
I don't know if you'd characterize this as a business book, but I think Napoleon Hill's Think and Grow Rich.
Yeah, and that's definitely popular for folks that are invested in real estate too. Favorite app?
I like the Trulia app, and it's actually more just for to understand what's going on with the local housing in my area, and I think it's actually an easier app to use than the other ones that are related in the same market.
Okay. And our final question here is, if something catastrophic happened, and I don't know how that would happen, but something that would happen that would really just, you lost absolutely everything, and all you had was $1,000 in the bank, what would you do to sort of launch your business again?
I'd take a loan. And the reason I say that is
you're changing the rules of the question here.
Well,
okay, go ahead.
Bill, I'm telling you that because I was in that position literally. When I left residency and I had a job, I was working for a national company, and I ended up not getting along with management. I got fired, and by the time I started my own company, I only had about $1,000 left in my bank account, and so I was getting a loan. But I will tell you, here's the thing. Here's what I would do. If I only had $1,000, I would probably focus on making money on the internet because, I've done it to a certain degree. But in the past, internet marketing, you can make money. I mean, it's not where I've made millions of dollars, but it's certainly a place where you can, with some, level of, fairly easily make probably enough to feed yourself.
Right. And I know lots of folks that are doing really well in that sphere that, are generating funds that can be invested elsewhere. And so that that's a good leveraging. I even did it myself when I was in Haiti, actually, and it was very lucrative, time consuming, but very lucrative.
In fact, you know what I did? Only just one little thing I did. I will tell you that the one thing I did have a fair amount of success with is I had a bunch of books ghostwritten, and they were in things like cookbooks and things like that, just based on what people were searching. And at one point, I was making $700 a month.
Just selling were they ebooks?
Yeah, they were just books on Kindle that people were buying. So,
interesting. Yeah. Wow, that's great. Gosh, it's been so great having you on. There's been some valuable information you've provided for our guests, and if anyone would like to get a hold of you, do you have some sort of a connection there that some way that they can reach you?
Yeah, I think the best way is probably just go to wealthformula.com, and there's a variety of ways to get a hold of me through there. You can, even the newsletter, the Accredited Investor Club, you can always just send me an email at buck@wealthformula.com, and I'm happy to respond that way as well.
Great. Well, thank you. We're at the closing part of this, and I hope you're publicist here kind of warned you of the way we close out our show. But every guest that comes on, we are called the Old Dogs REI Network. So we do ask our guests to give us their best old hound dog howl to help us to close out our show. So are you ready for this?
Yeah, actually, no, I wasn't warned of this, but I can.
I'll have to talk to Diane about that one.
Yeah.
But I'm sure you're going to be great at it. Okay.
All right, sure.
I know they have hound dogs up in Illinois.
Sure, I can do that.
All right, go ahead.
Oh.
All right, Buck. Great job. Okay, for not having any practice. So that's great. All right, Buck. Well, thank you so much. I can't thank you enough. I think there's some great information there, some good resources and things that people can check out even further. Obviously, your website sounds like a wealth of information as well. So I'd like to thank you and for all those out there that are listening, our Old Dog listeners. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us means a lot, and we greatly appreciate it. Well, that's the show for today, and remember, cash flow is king, and real estate investing the means. Until next time, keep moving forward, and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.